Welcome back to Talk Tickers. If you're tuning in, you know the drill. We cut through the noise and get straight to the numbers that matter.
No corporate cheerleading here.
None at all. Today we're heading to the West Coast to break down Banc of California, ticker BANC. The call was on January 22nd, 2026.
And this one was, it was a bit of a psychological thriller. A perfect case study in what happens when a company's fundamentals and the market's psychology are in two totally different zip codes.
It really is. I mean, the whole vibe of the session was just weird. You look at the headlines, and it's a party.
A double beat.
A double beat. Top line's up, bottom line's up. You have management on the call, and they sound euphoric. The CEO, Jared Wolff, is using phrases like volume is back and firing on all cylinders.
If you just read the transcript, you'd think the stock was up 10%.
Exactly. But then you look at the tape. The market looked at this incredible report and just gave them the absolute cold shoulder.
Stock closed down 1.75% on the day.
And here's the kicker. The volume was double the average, nearly 5 million shares. So you have management shouting, buy, and the market screaming, sell.
That's a massive dislocation. And, when you see a gap that wide, that's where you find the opportunity.
That's our thesis for today. This was a classic prove-it quarter. The numbers were good, but the timing of the growth made the P&L look, well, lighter than the balance sheet implies.
The fundamentals say buy, but the tape says wait. It's a great setup to explore.
Okay, so before we get into the psychology, let's just establish the baseline. Give us the snapshot of the results.
Let's do it. So, hard data. GAAP EPS came in at 42 cents.
And the street was at 37.
Right. So that's a nickel beat, a 13% upside surprise, which is pretty significant.
In banking, that's huge. You're usually fighting for pennies.
Totally. Then revenue. Clocked in at $292.9 million, beating expectations of around $288. So year over year, revenue's up nearly 11%.
Okay, solid headline numbers. But you and I know EPS can be manipulated. The real story is always on the balance sheet. Is the bank actually getting bigger?
And that's where the numbers get really loud. That's why management was so bullish. Loan growth was the star of the show.
What was the number?
15% annualized loan growth in Q4. I mean, to put that in perspective, most regional banks are fighting for low single-digit growth right now.
15% is aggressive.
It is. Total loan production for the year hit $9.6 billion. That's up 31% from 2024. This isn't a bank that's hiding. They are in full expansion mode.
But that begs the question, right? Are they just buying that growth? What's happening with the margins?
That's the other part of the good news story. They're not sacrificing the spread. The net interest margin, or NIM, was 3.20%. But the metric that really surprised me was deposit costs. They're actually falling.
That's rare. I mean, we're in a high-rate world. Most banks are paying out the nose to keep depositors.
Correct. But BANC saw their cost of deposits drop 19 basis points quarter over quarter, down to 1.89%. So you have new loans coming on at higher rates and funding costs coming down. That's the recipe for margin expansion.
All right, so let me play devil's advocate. You just painted this perfect picture. Growing loans, expanding margins, beating earnings, and yet the stock dropped nearly 2% on heavy volume. Why? What did the market see?
It all comes down to a timing issue. I call it the late surge. If you listen closely to the CEO and CFO, they kept repeating one phrase. The loan growth was heavily weighted toward the end of Q4.
Right, I remember that. The actual signatures didn't happen until late December.
And that is absolutely crucial for your model. Think about it. You sign a loan on December 28th. The asset is now on the books for the end of year report. The balance sheet looks huge.
But you've only earned interest for, 3 days?
Exactly. You get the asset growth, but you get almost zero revenue impact in the Q4 P&L. It's like buying a rental property on the 29th of the month. You own the building, but you haven't collected any rent yet.
And the market looked at the revenue and said, hey, for 15% loan growth, this number feels light.
Precisely. The CFO actually did the math for us on the call. He said if those loans had closed on October 1st instead of late December, it would have added about $13 million in loan interest income.
$13 million. That's not trivial for a bank this size.
It's massive. And that $13 million didn't show up in Q4. But barring some catastrophe, it's mathematically guaranteed to show up in Q1 2026.
So it's a coiled spring. The income statement is lagging the reality of the balance sheet.
And that explains the show-me attitude from the market. Investors are impatient. They see the promise of future income, but because it didn't print in the Q4 number, they're not willing to pay for it yet.
It's like they're being punished for succeeding too late in the quarter.
That is exactly what's happening.
Okay, let's talk about the other side of that balance sheet, the deposits. How are costs falling? I mean, everyone else is paying 4-5% for CDs.
It's not about CDs. It's not about retail. BNC is bucking the trend by growing non-interest-bearing deposits. NIBs. They added nearly 200 new NIB accounts in the quarter.
But who opens a zero-interest account in 2026? Why would you leave money earning nothing?
Businesses. Businesses that need complex treasury management. Think property managers, title companies, HOAs. They have massive cash flows moving in and out every single day.
So they trade yield for operational support.
That's the moat. They need the plumbing to work flawlessly, and they're willing to part cash for that service. And the data shows it's working. The average cost of deposits was 1.89%. But the spot cost, the cost on the very last day of the quarter, was 1.81%.
So the momentum is still improving, the trend is down.
Right. And for the deposits they do pay interest on, they're managing the beta really well.
Okay, let's pause on beta. In plain English, what does the 60% beta they mentioned actually mean for the bottom line?
Deposit beta just measures how much of the Fed's rate changes a bank passes on to customers. So a 60% beta means for every 1% the Fed might cut, BNC only plans to lower their payout by 0.6%.
So they capture the majority of the savings.
Yes. It means they have pricing power. They aren't desperate for cash.
Which leads us to 2026 guidance. Management threw out a number that, well, made me sit up straight. They're guiding for net interest income NII to grow 10 to 12%.
A very bold guide. But what's fascinating is the assumption behind it. They said that 10 to 12% growth assumes no further Fed rate cuts.
Wait, hold on. The entire market is pricing in cuts. Their model for double-digit growth assumes rates stay flat.
Yes. They're basically saying, we'll hit this number just on volume and mix shift, even if the Fed does absolutely nothing.
What happens if the Fed does cut? Does that hurt them?
You'd think so, but management argues they're in a heads I win, tails I don't lose position.
Yeah.
They said the bank is liability sensitive when it comes to ECR costs.
ECR, earnings credit rate.
Correct. It's a soft dollar credit. Instead of interest, they give commercial clients credits to offset banking fees. That rate is tied to the Fed funds rate.
So if the Fed cuts...
The bank pays out fewer credits. They said every 25 basis point cut saves them $6 million.
That's huge. So if rates stay high, they win on loan volume. If rates fall, they win on cost savings.
Exactly. It's an asymmetric risk profile. They seem to win in either environment.
Okay, it sounds too good to be true. There's got to be a catch. When a bank grows that fast, I immediately look at credit quality. Did we see any cracks?
On the surface, there was a scare. And I think this added to the sell-off. Classified loans ticked up.
And in this environment with commercial real estate, that word classified makes people nervous.
Extremely nervous. But the explanation was almost comical. The entire increase was driven by a single $50 million CRE loan.
One loan moved the needle that much.
Yes. And the reason it was classified was a closing delay on a payoff. And the CEO confirmed on the call that the loan actually paid off yesterday, the day before the call.
So the check was literally in the mail.
For once, yes. The risk was already gone. If you strip that one loan out, credit quality actually improved. Non-performing loans were down 9%.
Okay, so the credit scare was a false alarm. What about expenses?
They're guiding for 3 to 3.5% expense growth.
That's manageable with double-digit revenue growth.
Very. It creates positive operating leverage. And they're framing it as investment. They're spending on tech AI, Salesforce, Encino. They're spending to grow, not cutting to survive.
So let's put it all together. The credit was fine, deposits are cheap, loan growth is explosive. Why did it underperform the sector?
I think it really comes back to that show me attitude.
Yeah.
But there's a trading dynamic too. Over the last 3 months, BNC was up 25% heading into this call. The regional bank ETF, KRE, was only up 10%.
So they were already outperforming by a huge margin.
Exactly. When you have a run like that and you print a quarter where the income lags the balance sheet, some profit taking is just inevitable. Sell the news.
But for the long-term investor, the capital story seems great. They're aggressive on buybacks, right?
Bought back 13.6 million shares in 2025. That's 8% of the company retired in 1 year. And tangible book value grew 11%. They're doing all the right things.
All right. We've looked at the past. We've analyzed the present. Now for my favorite part of the deep dive.
Disclaimer time.
Absolutely. This is not financial advice. We are not your fiduciaries. We are just looking at public data and trying to find the signal. Do your own work. But if we were pitching a trade idea based on this call, what would it be?
I've got one. I was digging into the capital structure. I'm calling it the 2027 preferred stock slingshot.
Sounds traumatic. Break it down.
Okay, so very deep in the Q&A, there was a discussion about the bank's preferred stock. It's a legacy instrument that matures in 2027.
And it costs them. What?
A lot. It's incredibly expensive capital. The coupon is 7.75%. In real dollars, it cost the bank $10 million a quarter in pre-tax equivalent earnings.
Wait, $10 million a quarter? That's $40 million a year just going up in smoke.
Yes. On an EPS basis, it's dragging earnings down by about 20 cents annually. It's like running a race with a weight vest on.
Okay, so what's the trade?
The trade is you go long BANC with a 12 to 18-month horizon. You have three catalysts stacking on top of each other. First, that late surge loan interest finally hits the P&L in Q1. That's your immediate lift.
Catalyst 1. Lagging income arrives. Got it.
Second, you have the deposit cost gravity. As those NIBs grow and the spot rates pull the average down, the NIM just naturally expands.
Catalyst 2. Organic margin expansion.
And third, the slingshot. The eventual takeout of that preferred stock in 2027. When they refinance that or pay it off, they automatically unlock up to 20 cents of EPS.
Without selling a single extra loan.
Exactly. It's pure bottom line efficiency just waiting to happen. The market ignores it because 2027 feels far away, but for a one-year hold, you're buying a machine that's about to get way more efficient.
And to strip out the market risk.
You short a generic, low-growth, regional bank ETF against it, like KRE.
So you're not betting on banks, you're betting on BAN's specific capital structure fix.
You're isolating the alpha. You're betting that BAN's taking off its weight vest will make it run faster than the pack.
I love it. It's a specific event-driven thesis that's just hiding in the footnotes.
The engine's rebuilt, the car's moving fast, and they're about to drop $40 million of dead weight from the trunk.
All right, let's wrap this, recap the situation.
BANC delivered a double beat. They promised a 10 to 12% NII ramp. They proved they can grow loans at 15% while lowering deposit costs.
But the market blinked because the income from that growth didn't hit the Q4 P&L.
The speedometer is lagging the acceleration. The car is doing 80, but the dashboard still says 60.
And that's the opportunity, the disconnect between what happened and when it gets reported.
Precisely. The fundamentals say buy, the tape said sell, and the capital structure says hold on for the slingshot.
A fascinating quarter and a great reminder that sometimes the market reaction tells you more about investor patience than the company itself. We're going to leave it there.
Couldn't have said it better.
Thanks for listening to Talk Tickers. Remember to do your own research, and we'll catch you on the next deep dive. Talk Tickers out.